Hello students, welcome to Accounting Explained at AccountWise Academy. This is Lata Venkateshwaran. This is the part 2 video of NCERT chapter 2 11th accountancy portion, theory base of accounting. This chapter I have explained in a very simplified way and with lot of examples so that you can understand the lesson very easily. If you want to look into the important questions and MCQs of this chapter, you can see the shorts in our channel Accounting Explained at AccountWise Academy. The link of the part 1 video I will be sharing it in the description box which you can go through. In today's video, we will be covering the following topics for the chapter 2 theory base of accounting. They are revenue recognition or realization concept, materiality concept, full disclosure concept, consistency concept, conservatism concept, materiality concept and the objectivity concept. With this, we will be covering all the concepts given in the Chapter 2. Revenue recognition concept or realization concept. So how is revenue defined in a business? Inflow of cash from two sources. What are the two sources? Selling goods or services and the other one is using your own resources. See, you are having a business and you are going to invest the money you have earned from your business outside. For that you will get some interest, no? So that is also treated as revenue for the business, but it is from other sources, not from the business. Next, some royalties. If you are having some patent from your business, so then the income you receive from that patent, that is the royalties, are also treated as income from other sources. Okay. Next, revenue recognition. Recorded only when realized. Meaning legal right to receive it exists. That is, only when the goods sold you are going to record it. Or when you are in the service business, when the services are rendered, you are going to record it. It's not like when the customer comes and sees your product and he wants to buy the product, then you cannot record it. Only when the goods go out of your premises or when you actually do the services, only you can record the transaction. Okay. Next, credit sales. So if you're going to sell some goods on credit, then the revenue you may receive it later, but then that is also treated as revenue. Okay. Time based income like rent, commission, interest, etc. recognized based on time frame earned. See, March rent you will be paying in April only, but your year closes on 31st March. So you will take that March rent in the month of March itself. Though you pay in April, you will take it in the month of March itself. That is one example. Another example you can take salary. See, your parents will be working, right? So the salary they will get only the next month for the previous month, right? But it is considered as for the previous month income only, not the next month income. Okay. Next, there are some exceptions for this. What is that? Long-term projects like construction recognize only proportional revenue based on completion. See, for example, construction, there is one construction project going on. Okay, flat project. Okay, so they will take only, so imagine that the cost of the project is 1 lakh. This is too less, but I am telling you 1 lakh. Okay, for our example, let us take as 1 lakh. Only there may be different stages for completion. Stage 1, stage 2, stage 3. In the stage 1, if they have completed 25% of the project, then in the stage 1 they can take only rupees 25,000. 1 lakh into 25% is 1 lakh 25,000. Like that they can take only proportional revenue based on completion. And higher purchase sales recognize revenue per installment collected. if you are in a hire purchase business, like when you are going to sell cars on hire purchase, and if the monthly installment for a customer is rupees 10,000, this 10,000 will be treated as revenue only when the installment is collected. Okay. Matching concept. In the matching concept, first we have to match expenses to revenue. The matching concept ensures expenses are matched to the revenue they help to generate within the same accounting period. Okay, so we are going to take the same tea stall example which as we took in the part 1 video. Okay, in the part, so here the expenses, what are the expenses for tea stall? Buying milk, buying tea leaves, okay, like that, buying sugar, it has to be matched with the income. Income is selling tea for the same accounting period. If you are going to take this daily and tally it, then it has to be done daily. If you are going to take it monthly, then it has to be done monthly, and you have to match the expense with the income. Okay, revenue and expense timing. Recognize revenue when earned, sale or services, and expenses when used, not just when paid. So, even if you have purchased something on credit, or if you have sold something on credit, that is considered as purchase and that is considered as sales, not when you pay. Okay. Examples: salaries, rent, insurance. Okay. Expenses recognized based on usage period, not payment date. So this example we saw salaries and rent already. So I am going ahead. Cost of goods sold. Deduct unsold goods cost from total purchases to match cost of goods sold with sales revenue. See, for example, if you have remaining tea leaves, sugar, etc. Okay, all the ingredients which you use for making tea, if there is something left out, then we have to deduct all these unsold goods from the total purchases, because to find out the exact cost of the goods sold, we can use only the goods which we have consumed. Okay, not the goods which we have purchased. So we are going to deduct unsold goods cost from the total purchases and get the correct cost of goods sold, and that has to be matched with the actual sales revenue, because actual sales would have been made only with the goods consumed. Okay. So next, profit or loss calculation. Consider all earned revenue received or not and incurred cost paid or not for a clear picture. So whether you have received, whether you have made sales with credit or with cash sales, all the sales should be considered. Similarly, whether you have purchased something on credit, or if you have purchased something with cash, that all should be considered. Or if the salary here, if it is outstanding, we have not paid the salary for 1 month, that should also be considered, because that is also our cost. Okay. Then only we will get a clear picture of our profit or loss. Remember, this concept ensures accurate profit or loss calculation by matching income and expenses they generated regardless of the payment timing. March month rent, if you are going to pay in April also, that doesn't matter. You have to take only in the month of March, because that is the expense of March. Okay. So then only we will get the correct March month profit or loss. Okay. Full disclosure concept. Imagine your stall has become famous for its delicious tea. People come from all over to enjoy it. But how do you know if your stall is doing well financially? That's where financial statements come in, like a report card for your business. Users rely on financial statements. Financial statements are used by different people, like investors. Why do investors need financial statements? They might want to invest in your stall, so they need to know if it is making profit. Okay, then comes the lenders, primarily banks. Okay, if you need a loan from a bank, then to expand your stall, primarily the bank will check your financial statements and see whether you can afford to repay them. Okay, then suppliers, they might want to know if you can pay them on time for the milk, sugar and the other supplies you buy. So these are all the users who needs your financial statements for making their financial decisions. Clear communication is essential. See, you have to be transparent and honest with your financial statements. Okay, so you cannot be giving any false information. Next, what does full disclosure mean? Okay, now let us see what does full disclosure mean. Full disclosure means sharing all the relevant information about your stall's finances, both good, like high sales means high revenue. Okay, not only good, you have to show even the bad expenses also, bad things also, like low sales or bad debts, or when the expenses are very high. Everything should be shown in your financial statements. This allows everyone using the statement to understand your business's true health and make their informed decisions. So what does full disclosure mean? Like recording all your daily sales even if someone has not paid yet. Okay, that is, even if you have sold on credit also, you have to show the full sales. Listing all your expenses including cost of ingredients, rent, electricity, etc. By being transparent. So benefits, see here. Users can accurately assess profitability and financial soundness. Users, we know who are the users: investors, lenders, suppliers, etc. Okay, and ensuring transparency. Regulations like Companies Act and SEBI. SEBI is Securities and Exchange Board of India. Mandate ensure complete disclosure. You have to have a complete disclosure of your financial transactions. Okay. So by being transparent, you build trust with everyone involved. Like we know users, who are the users? Investors, banks and suppliers. Remember, full disclosure helps building trust and transparency, leading to more informed financial decisions for all stakeholders. Now we are going to see consistency concept. First point is financial statements need comparison. So useful information requires comparing a company's performance over time internally and with competitors externally. What is it? See, financial statements are similar, right? So they are reports about a company's performance, but to understand the full picture, you need to compare them. First is over time, that is internally. What is that? See, comparing your tea stall sales this month to last month helps you to see if you are growing or not. This is called internal comparison. Next is comparing with the competitors. Your tea stall will have competitors for sure, right? So comparing your sales to your competitors helps you to see who is doing better. This is called as external comparison. Next is directly comparable. Consistent accounting policies ensure fair comparison by using the same methods across periods and companies. See, to make fair comparisons, everyone needs to play by the same rules. Suppose you are playing cricket, you and your opponent team should follow the same rules to see who is the winner. Right? Similarly, even while preparing financial statements, we have to use the same accounting methods. That is, the consistent accounting policies should be followed when we compare internally and externally. Okay. So next, investor example. Comparing profits over 1 year, that is this year to the next year, that is year on year, with different methods leads to inaccurate conclusions. If one company is using a different method to calculate profit than another, then comparing their statements wouldn't be accurate and it will not lead to the correct conclusion. It will lead to only inaccurate conclusions. Consistency reduces bias. Okay, using consistent methods eliminates personal influence and improve data comparability. So, companies need to use consistent accounting policies. It should be consistent. So, this has to be highlighted. Okay, this means using the same methods over time and ensuring they are similar to what other companies in the industries use. Okay, so changes are allowed. Switching policies is okay, but disclosure of the impacts and reasons is crucial. Some companies might need to change their accounting methods. That is okay. So changes are allowed, but it's crucial to clearly explain the change and its impact on their financial statement. Imagine you are going to participate in a competition. The rules may change, but everyone needs to know the new rules. Okay, new rules, so that they can participate fairly and the game will be played in a fair manner. So, in conclusion, we can say by following consistent accounting practices, everyone reading the financial statement can get a clear picture of company's health and performance between periods, that is internally, and with the competitors, that is externally. Conservatism concept. Wait for real profit. Recognize income only when earned and not just potential gains. You can record income only when you sell a cup of tea and not when someone promises to buy a cup of tea later. Okay, prepare for potential losses. Anticipate and reserve for future possible losses. That is, if your sugar gets wet or if your milk gets spoiled, you have to anticipate and keep some reserve for the future losses so that your business goes on smoothly, even if it is uncertain. So these are all uncertain things which we do not know, which is not in our hand. It is not in our control. Okay, value stock cautiously. Use the lower value between cost and market price for unsold goods. You have leftover tea powder, you have leftover sugar. How will you value? You will value, and first you will compare the cost and the market price. Cost is the price at which you bought or the historical cost which we saw earlier. No. So we have to find out the price of the unsold goods by comparing cost and the market price, and we have to take only whichever is lower. Protect creditors. Prevent overstated profits. How will you prevent overstated profit? You cannot just show increased sales or you cannot show decreased expenses. Everything should be in actuals. Okay. And risky dividend distribution. Suppose you have a very big corporate company. You cannot just distribute dividends to the shareholders as such by giving high rate of dividends to increase the image of the company. That is not correct. You have to always follow the conservatism concept. Okay, avoid hidden profits. You should not deliberately undervalue assets to create misleading financial reports. Your report should be correct. Now we are going to see conservatism concept is used to make informed decisions. Okay, so first it is used to make informed decisions and to prepare for unexpected situations and to maintain a good reputation. For all these things, we use the conservatism concept. Okay. Materiality concept. First point is efficiency. Emphasizes practicality and avoiding unnecessary work for small items. Okay, you wouldn't spend hours counting and recording the cost of every single sugar packet you use. You will not buy 1 kg sugar packet. What you are going to buy? You are going to buy them in bulk and estimate their daily usage, saving your valuable time. Next is cost effectiveness. Highlights the focus on optimizing resources where it matters most. You wouldn't invest in expensive accounting software just to track the cost of your disposable teacups, right? You might simply keep a record of the total amount spent on them. Okay. Immateriality threshold introduces a specific accounting concept related to the materiality limit for small amounts. Imagine you set this threshold at rupees 10. Any expense below this amount wouldn't be tracked individually. Instead, you might group all these expenses together and call them as miscellaneous expenses. Okay, they are called as miscellaneous expenses and will be recorded at the end of the month. Next is de minimis principle. It refers to a legal concept indicating disregard for trivial matters, aligning with small asset expensing. This principle allows you to treat very small expenses differently. For example, instead of depreciating a new tea stirrer which is cost less than rupees 10 over its lifespan, you might simply record it as an expense when you buy it. Okay. Next is practicality. What is the practicality of using the materiality concept? It provides a better perspective using reasonable approaches for low value items. Overall, the key is to find a reasonable way to manage all the small expenses. You wouldn't want to waste time on excessive paperwork, but you also want to maintain a good financial records, right? So you might keep a small notebook or a simple notebook to record daily teacup expenses, daily sugar expenses of sugar usage expenses and other small costs relevant to your stall's operation. This is the last concept which we are going to see, which is objectivity concept. First point is be neutral. Record transactions free from personal bias supported by verifiable documents. Okay, instead of recording an expense as expensive milk, you cannot record an expense as expensive milk. What you have to do, you should record the actual price you paid for the milk based on the receipt or the bill you received from the store. That is the documentation. Okay, paper trail matters. Use evidences like receipts, invoices and delivery challans to ensure objectivity. You will have to keep all your receipts, invoices and delivery challans for your purchases like milk, sugar, tea leaves and disposable cups. These documents serve as proof of how much you spent and what you spent also. Okay, so this is taken as a proof. Historical cost for the bin. Verifiable past cost. Purchase price promotes objectivity over unreadable market prices or values. You wouldn't record the value of your tea stall equipment based on what you think it might be worth today. Instead, you would use the original purchase price you paid for it, which can be verified by the receipt you have. This is called the historical cost. Market value of things like equipment the instruments or everything you use can fluctuate and are subjective, whereas the purchase price is a documented fact since you have the receipt for it. Okay. Next is market values. Subjective and variable market values makes objectivity difficulty. So this is what we saw previously. So market values may be fluctuating, but the historical cost remains the same since it is also verifiable since we have the documents for it. Okay. Reliability comes first. Documented cost ensure trustworthy and comparable financial information. So if you have the documents for any other purchase, any purchase you have made, so it becomes, the expense becomes trustworthy because of the documents available, and it can also be compared. Okay. So objectivity is crucial for building trust and transparency. So transparency is very important, and trust is also very important for a business in financial statements. By relying on verifiable evidence, that is the documents available, we avoid bias and ensure accurate representation of a company's financial health. Okay, with this we are coming to the closure of the part 2 video of chapter 2. Do like our video and share it with your friends if you find it helpful. Subscribe to our channel, which will encourage us to make more videos like this one. If you would like to inquire about the accountancy classes which I take, or to get more worksheets for problems with solutions, contact us at acct.wiseacademy@gmail.com. Thank you for watching.